Hey everyone, welcome to this week's edition of the Grain Gauntlet. Back after a 2-week hiatus, I'm here with Hedge Plus owner Patrick Hayes. As usual, we've got 5 questions from clients. 4 of them are from current clients. One of them is from a prospect. Lots of, I guess, questions and talked about what the market's been doing. This downturn we've had in the last couple of weeks after such a long, sustained rally. So, Pat, are you ready for questions about the
I'm
market?
ready. I think I have good answers because I'll tell you, yesterday I worked the extra hour, couldn't get off the phone. Guys were calling it. Most call-ins I
Yeah.
have had in 5 years, and guys are
Wow.
very concerned, asking lots of questions. So let her rip. I'm ready.
All right, sounds good. First question is, why haven't you sold out of old crop corn yet?
That's a really good question. I got that a lot, and I'll tell you why. I have to stand up because we're trying to do this. Make lemonade out of lemons, okay? First of all, we made major sales early in the year. We got 50% corn and soybeans in new crop. We're 75% in old crop corn. We're 90% in beans. We have the luxury of waiting as long as we possibly can to see a rally. Back in 23, when we had our last summer rally, when you have a summer rally due to weather, it's not 30 cents. It's 75, 80, a buck. It takes off. When you have a weather scare, it takes off like crazy. And there's a couple things that tell me that that could happen in July. That's the only thing that stinks. I'm hoping to get it before the end of the month, but it may not happen until we get into pollination. But we're starting to see colder water temperatures off the Pacific Ocean like we did in other years where we had dryness in the Midwest. The best correlation to dryness in the Midwest is cold water off the Pacific, kind of like a reverse C from Alaska's coast down through ours, and then the south leg of the sea, reverse C, goes out to Hawaii. That has been getting colder and colder the last 3 weeks. That is one thing that I know will make it drier here in the Midwest on a very high percentage chance. That's a concern. The war is not solved. Okay, we're in a stalemate right now. I think Iran is comfortable with barricading, that they think they can outwill us. And I think President Trump is saying that we'll destroy their economy by keeping a barricade in place for the Iranian ports. It's a matter of will right now instead of military might. And I think it's going to go on for a while. That's going to drive crude back up, higher prices. And the longer it goes on, of course, the worse long term it is for world economic recovery. But I think short term, that puts risk in our market. We have a drought monitor that's totally is circling around the Midwest, right? The heart of the Midwest is in pretty good shape. We got some rains. We're going to get some more rains over the next 6 to 14 days, okay? We're going to be okay going into mid-June. However, the drought monitor shows you that there's no subsoil moisture in the plains at all. In the southeast part of the United States, there's no subsoil moisture. So what that means is we have to have regular rains all year long. We have to have an inch of rain every week, or we're going to have potential for flash droughts with the higher temperatures that we're going to see. So I think there's enough risk this year to see a spike higher. Lastly, inflation. What inflation in the corn market? We don't have any right now. It's falling apart. And with inflation, that means end users are going to buy when it's cheap. I expect end users to come in big time with July corn back down below 440 and December corn where it is in the 460s. I expect exports to jump. I expect buyers to buy because this is really cheap even compared to the world. So all those reasons why we haven't sold. But the biggest reason is because of earlier sales. We were aggressive when we were near $5. When you're aggressive at a higher level, you could take a little bit more risk at the downside. I think the risk is going to be worthwhile. I think we're going to get a rally between here and the 4th of July.
Okay, I'm sure the follow-up that you got from many people, it's the same question, but for soybeans, any difference there or any different reasoning?
The weather is going to be a concern. I think it's a weather market that will affect corn and beans pretty equally, more so in July for corn, more so in August for beans. But I think the second half of the growing season is going to be tough, and that the market's going to look for rally potential. The other thing with beans is, have we planted more corn acres or not? And you don't have to lower bean yield by 5 bushels like corn to get a rally. You can lower it a bushel, and that takes off 80 plus million off of 350. All of a sudden, you're really tight. Take 2 bushels off, and we're pipeline. So it doesn't take a lot to destroy beans or to move beans. I think beans follow corn with weather concerns and issues. I would expect at some point China will start buying beans again, especially with the price going down. I think there's one more significant rally left there. We've only got 10% of old crop left. I don't have to sell new crop corn or beans till next spring because we're already at 50% at pretty good prices. So if I do expect it to follow corn bean prices.
All right, good. This question says, is the war becoming less important as it continues to drag on?
Yes and no. Yes, short term, we don't have the emotional ups and downs. But crude isn't going back to $60 a barrel right now as long as the Straits of Hormuz and the U.S. has its barricade in place. It's just not. The world will adjust, and we're seeing people use less. But we're also seeing, as you taught me today, showed me today in an article, a big drawdown in world crude reserves, and we don't have them anymore. So there's much more risk if this continues. We can't keep drawing down what we don't have in reserve anymore. So the risk becomes greater as we go, more fluctuations in crude as we go. Bottom line is, I think the risk is growing instead of diminishing, but the emotional price reaction won't be there. It'll be slower and more continuous.
Right. And I think that ties back to the questions about cash yield. You know, you had the luxury, given where we stood on old crop sales, to use that last 10% for the what ifs. The what ifs so far haven't come, but this is another what if that could hit at any time.
Yeah, things could get really crazy. I mean, if the war broke out again, which I don't expect. I expect the stalemate to last. I don't expect it to get solved either. I expect it to go back and forth until somebody crumbles, and that's going to take time. It might take 3, 4, 5, 6 months.
Yep. Yeah, we're at the point where the war doesn't even have to break out again to cause a rally because of how far behind oil production, oil movement, how much reserves have been tapped into. When that supply shock hits, it could spark another rally. And another thing we talked about this morning was it would probably be brief because if oil does spike on this and gets to 150, 160 a barrel, it's going to really slow economies, which would be something we'd have to watch for later, which would be the slowdown in demand of just about everything.
Yeah, that's the scary part. Long term, next year, we could have much worse demand. Of course, we could have the world celebrating with the oil afloat right now that gets to market. All of a sudden, we have really cheap prices, and the world economy recovers quicker than what we're expecting. But yeah, the longer this goes on, the more risk there is to world recession, no question about it.
Okay, good. All right, this question says, prices are falling back, but inputs haven't budged a bit. That clearly isn't sustainable, so how is this going to shake out?
Give that to me one more time. That's a long question.
Okay. Yeah, prices are falling back, as we've noted, but inputs haven't come down at all, and that's not really sustainable for farmers. So how would that shake out over time?
Yeah, well, we better solve the problem with the Straits of Hormuz, or this big move down isn't going to last. One of the two has to give. Either we got to come down in input costs, and it's starting to get later and later for the South American crop because they'll be planting in 2 or 3 months. They're going to be able to afford to buy urea for their crop. Okay, that we're going to lose some production for sure if urea costs are still where they are, nitrogen costs are still where they are when we get to the South American crop. Next year we have issues. We won't be able to buy fertilizer and urea early this year to put it on in the fall. Guys will wait till spring. Prices have to either come down with the input costs or they got to go up on the farm for what we're growing. It's one of the reasons I'm bullheaded right now. One of the two has to happen. And I think commercials are smart enough to say, okay, we got it good right now, but let's start buying, let's start exporting, let's start moving this stuff because it is really cheap and we got to get it higher or we're not going to have it produced in years ahead. We will lose acres. There's no question about it.
Yep, just some more dominoes that will fall yet, that haven't fallen yet,
Right.
even though things might be calming down with the war and people are starting to price that out. There's definitely some impact coming yet.
Right. And, people look at this stuff as static, that this is going to stay in place. Well, as demand grows or falls apart due to prices will react to that. It goes back and forth. It's a swing. We're not going to stay low all the time. We're not going to be high all the time. It's going to swing back and forth because the fundamentals will swing back and forth. Right now, we have ideal weather except for guys in South Dakota. Don't get mad at me. I said that in my ASV, and I got a lot of phone calls that some parts of South Dakota are too wet, some are too dry.
Right.
Okay, but for the overall Midwest, we had good planting weather. Got done pretty quick, got rains after the majority of the crop was planted, and it's off to a good start. Not a great start, but a good start. That doesn't mean we're not going to have 2 weeks of heat come up in July, and nobody can tell me that's not a possibility because it is. No one can tell me it's not also a possibility we're going to have perfect weather all year. Less likelihood in my eyes than you have in some periods of hot and dry. But anything can happen with weather. It's going to change the fundamentals, it's going to change demand. And that's why we're in front of the computers every day, 10 hours a day, watching things, especially in the summer. I don't take summer breaks. I don't go on vacation with my family for 2 weeks in the summer because you can't do that. It's impossible. You'll miss way too much because too much changes in the summer.
Yep. Okay, good. This final question is from a prospect, definitely someone who might not be familiar with how we do cash sales. But for any other prospects out there that might want to hear this, the question says, do you typically make sales when a target price is hit, or do you scale sales and sell by percentages throughout the year?
I think target pricing is for those who don't have the time or just don't want to pay attention to what's happening in the market. Because if I pick a target at 490 and we just had 2 weeks of hot dry, the environment has changed, gang. Okay, and 490 is no longer a good price. Maybe 540 is a good price with 2 weeks of hot dry over the center of the U.S. Variables change all the time. Targets are, in my opinion, be yelled at for this, ridiculous, absolutely ridiculous to have a target that you're going to stick with because you set it at some point that you're hoping it was going to get there. You have to pay attention to the changing environment, how this market changes to make good cash sales. So I don't use targets. We always leg into sales. We never sell 100%. So you sell when you have good opportunities. You make the percent sale based off how good of an opportunity it is, what the risk is going forward. It's a continuous measurement of risk reward.
Good. Yeah, definitely maintaining that flexibility.
Yes.
You have to, because the market's constantly changing, right?
Well, and if you don't believe that, 3 weeks ago, you guys were talking about 530 corn, and now it's 460. So, yes, it's always changing. There's always something new that's going to happen. We have weather in the summer. It's the biggest variable. It dominates everything. But weather can change. These guys aren't right from week to week, for God's sake. Pay attention to the 2-week forecast and watch how many times it changes before we get to it. It's amazing. Okay? So no one knows what's going to happen with weather. You got to stay on top of what is happening, crop conditions, crop progress, exports, weather, war, everything, and you got to measure those risks continuously because they change from day to day sometimes.
Okay, good. All right. Well, thank you for questions, everybody. Thank you for those answers, Patrick. Hopefully, people will find some of these replies and the info that you've shared today useful. I think it's been a good session, and well, hopefully the weather's good for our guys, and hopefully we get some clarity from what's going on with Iran here soon.
Yeah, I'm hoping all my guys get rain and nobody else does. So that's kind of the gist of it.
That's kind of what I wanted to say.
Yeah. The bottom line is it's June 3rd. Okay. We're just starting summer. Yes, we have fallen off. Big, sharp, volatile move down. Volatility has just started, gang. Get ready. We haven't seen crazy summer price action for a while because we've had 2 pretty solid summers in weather without major risk. Get ready. It's due. It's due to have some volatility. I think we're going to see some pretty crazy price swings going forward.
All right. Sounds good. Have a great week, everybody.
You too. Take care.